Hi, I'm Urmi Desai, editor of Move Smartly, and this is the Move Smartly Show. Our episode today is our monthly feature, one of our favorites, called The Situation. This is when we ask my co-host, John Pasalis of Realosophy Realty, to respond to your real estate questions about your buying, selling, investing, or renting questions across the GTA, the Toronto area. And this month, it's no exception, John. A lot of questions about different scenarios.
Yep, looking forward to it as always.
And before we get started, you can send in your own questions to askjohn@movesmartly.com for consideration on future shows. We also get to some other questions that, John may have received through emails and other channels. You can also ask us through our X Twitter channels at John Pasalis or reach the show at Move Smartly. All
All
right,
right,
John, how are you feeling today?
very good. Looking forward to today's chat. See what interesting questions we got.
All right. First question is short and sweet, but I think one that many will have interest in.
hmm
Dear John and Ermi, we currently own a starter townhouse in Mississauga and are
hmm
looking to upsize to a detached home, but would like to keep our current townhouse as an investment property. What
hmm
advice would you give to someone in our situation?
That's interesting. I just met with a couple actually in a very similar situation. They were in Durham, not Mississauga. Um, a good question. I mean, I think this has been a common question for years. Um, I mean, listen, before I answer this, I think I'm going to unpack kind of how I approach these types of questions, which I think is a little bit different from most people in my business. And it really has to do with kind of how I got into real estate. I got in when I was like 23. I had to, take over kind of my family's business because my dad got sick, and I was just paranoid about making mistakes. So when I asked people for advice, people in the real estate industry, lawyers, accountants, about a particular real estate decision I needed to make, my approach is always primarily focused on understanding all the reasons why I shouldn't do something, right? Like, obviously, I'm going in with them thinking, should I buy this property? Is it a good bet? I've done some due diligence. There are reasons why I think it's a fantastic idea. I don't really need a cheerleader. I don't need help for that side. Because if it was a terrible idea, I wouldn't be doing it, right? Or I wouldn't be contemplating it. What I needed to understand were, what am I missing? What are the downsides? What are the risks? Um, and it helps inform and gives me some insight into what I'm missing. And of course, obviously, I look for the positives as well, but the negatives were always more critical. If you want to make shrewd decisions, you need to know what you don't know, quite frankly, and all of the things that you're not thinking about. And a lot of these were oftentimes commercial transactions, were obviously a lot riskier. So, when I met a couple like this, I don't know, a few weeks ago, that's kind of how I position this, one of their questions was, well, do you think real estate's a good investment? I'm like, obviously, I think real estate is a good investment. I mean, I invest in real estate, my family's in this business, we help people in real estate, but it doesn't mean you do it at any cost. It doesn't mean no matter what, you always invest in real estate. And I talked through some of the downsides with investing, and obviously with this particular couple, I don't know their situation. I don't know their financial situation. Obviously, if you own your home outright and there's no mortgage on it, it's a lot easier to do what you're doing, right? Because you have $1 million, say, in equity. It's a little bit easier to upsize and keep your current home. If you don't, and you're taking on more and more debt, even if the banks approve you, you have to be very cautious because I can't remember the couple I was meeting with. I think what would ended up happening was like they're in a similar position where they had a townhome and they're going to upsize to a detached home. And the monthly carrying costs to keep that townhome, for example, between their mortgage payment, their taxes and insurance and things like that would be, I think it was just over $4,000 a month, right? And I think we estimated their income, and I'm just off the top of my head. I mean, I don't remember exactly, but something like close to 3,000 or 2,800 or something like that. So, they'd be short about $1,000 a month when it's rented, right? And the first thing I warned them was when you become a landlord of a home in the suburbs, you need to be very patient when you're deciding who to rent to. I mean, everyone hears there's a housing shortage and we need to, there's not enough housing. Yeah, and of course, you're going to have 50 people applying for your property. It doesn't mean you want to rent to all of them, right? And to be clear, there's a lot of risk as a landlord when you put a tenant in. If they're not fully qualified, they're not good, and they stop paying you rent, it could take you a year to kick them out. So you're without rent for a year potentially. So you have to be very cautious. And we've been many situations where our clients are moving out of their suburban homes and keeping them where we get like 30 to 40 applications before our clients finally accept one. So you're vacant for a month or 2 months or 2.5 or 3 months while you're waiting for someone. So as a landlord, can you cover that extra 4 grand a month over and above your own housing costs while you wait for somebody, right? Because that in some ways is the best case scenario. I mean, the best case, obviously, rent it right away, but the best case, it takes you a couple months and you get someone fantastic and then you're good. Like the worst case is, and we see this a lot. People don't anticipate vacancy in their monthly cash flow, right? And then they're vacant for a month and then they're desperate to rent it out to anyone and they kind of compromise on what they're looking for in terms of a profile. So then the tenant doesn't end up being as good and their unit gets damaged or they're not paying rent or they have all of these headaches. And it's a very challenging process working with the landlord tenant board if you have a tenant that is, not the best, that is not paying you rent, that is not paying you on time, damaging unit. It's very challenging. So, that was my message to them that they have to be prepared for not just all the good potential side effects, is also, these risks, and they're very real. And that's not even a real risk that you're gonna be vacant for 2 or 3 months. That is like a high probability event because it's just hard to find people. On top of that, you got to be fine with being short $1,200 a month on your carrying costs. You know, forever basically because the mortgage or the rent doesn't cover your carrying costs. So there are a lot of things. And of course, you've got to think about, yes, long term is a 20-year plan. And this is how everyone approaches it. 20, I want it as a long-term investment. And I think that is how people should be investing, to be clear. So that mindset that I want this as a long-term play is the correct one. You just need to be able to afford that for the long term, right? And I think what happens a lot of times is for some people, they end up upsizing to a home that doesn't kind of entirely fit their needs. Like they want the investment property for 20 years, but the home they're upsizing to isn't the home that they want to live in for 20 years, right? So there's a challenge there and a tension. Like, yeah, okay, you might have this investment property, but now you're upsizing to a home that doesn't entirely fit your needs, is not the home that you want to settle into. So, and that's usually what happens because if you're keeping the investment property, you can't spend as much on your next home, right? So this idea that it's like one is better than the other, I mean, it's highly personal because if you're upsizing, you're spending a little bit more on your home, you're still invested in real estate. I mean, yeah, you don't have a second investment property, but you may invest somewhere else where you don't have that financial pressure if you have vacancies. And we see this a lot today. It's like the number of emails and calls I get from like people in very difficult, stressful financial positions because their rent's not covering their payments, because their tenants aren't paying them, because their properties have decreased, and they just don't know what to do. Like I think people have missed during this sort of bubble phase. Everyone just had this expectations like that real estate is this lottery ticket. You know what I mean? That, just buy it and load up. And I mean, and that's obviously not the way to think about real estate. Like real estate, of course, goes ups and down as we are seeing now. And you just need to be in a position where it's something that you can actually hold on to for the long term, right? And not overextend yourself. Um, which reminds me, I'm going to go on a tangent because we do that on this show because there's no one to tell us what not to. And actually,
Because we let each other.
we let each other. I mean, it reminds me. I don't know if I told this story before, but it's obviously very relevant to this. I may have mentioned it on the show. I mean, I honestly can't remember. But when I first started with my family stuff, my dad kind of had MS, so it affected him cognitively. So sometimes he had good days and I could chat with him, and sometimes he had bad days and I couldn't. So, one of his good days, I think I asked him, I'm like, how did you like survive the 1990s real estate collapse, right? Like my dad did the opposite of what every financial advisor or expert tells you to do, which is diversify. He had everything in real estate, right? So he had like all his eggs in one basket. And that basket didn't do too well for a long period. And a lot of people lost everything, right? So I was like, how the hell did you not lose everything? And it's like, I feel like that's a legitimate question. And then he turns to me and he's like, well, that's easy. I just didn't sell anything. Like, and he kind of gives you this answer like you asked him the most stupid question in the world. And I'm like, and obviously I was like, okay, like, it's not that simple. Like, how did you not sell everything? Like, everyone else lost money. A lot of people went broke in the 1990s. We really don't know. The market collapsed, prices plummeted, the economy was terrible. So it's like, well, how did you not sell? Like, what was your magic recipe? And he actually said to me, it was interesting because he said at that time, everyone that sort of was in the real estate space, the brokers, the lawyers, everyone's like, you have these properties, you don't have a lot of debt on them. You should refinance them, get more debt, go buy another one, just kind of this process, right? Of recapitalizing and reextending. And he said, well, okay, that's great. I mean, I could do that, but you know, what happens if there's a recession tomorrow and my commercial property's vacant for a year and I've got to pay X thousand a month, not just on my property taxes, but on my mortgage? And he said everyone's reaction was the same. Their basically reaction was, you worry too much. The economy's booming. This is how the smart people make money. You just refinance, load up on debt, and buy properties. And he didn't do that because he said, you know what? I like to sleep well at night. I don't need to be the richest guy on the planet. So when the market tanked, and he said we were there like their properties vacant for a year, and he said it was difficult. We had to pay our taxes. We didn't have a lot of money coming in, but we weren't forced to sell because they weren't over leveraged, right? And I think this is a concept that's kind of missed a lot in Canada and North America. There's this idea you have to load up on debt to make money. And yes, that works well when things work well and are moving well. But we're seeing now with a lot of people stretched and losing that it can also bite you and hurt and have some negative side effects. So, if you want to over leverage, if the market does well, it will pay off. But, sometimes there are obviously negative side effects. When you personally are in a situation where you can't afford these high debt payments, you could find yourself in a difficult situation, especially with residential properties where, you have difficult tenants who aren't paying. So, at the end of the day, I obviously have a bias from how I grew up where I'm relatively risk averse. I don't like to stress about these things too much. And the only way to do that is just to think about your risks, your downside risks, and plan for them and be prepared for them. And if that means you keep your home as an investment property, all the power to you, but you just have thought about that and plan for how you're going to mitigate risk down the road. And that's typically how I approach most decisions, I'd say. End
Well,
of rant.
your dad always sounds like a wise man through the stories you share. And I think that's a lot of good food for thought. And I guess my other add on would be it doesn't even have to take a serious recession. It could be one, someone in your family wants to take time off from their job or maybe to
Yeah.
family. And so that becomes another consideration. It may seem easy to finance two properties now, but, things can change.
Yeah, and you're 100% right. Like, and people don't think about that, how your real estate decisions today can actually constrain or negatively impact your decisions in the future. Like you said, your partner wants to take time off, mat leave. You want to start a new business, but you've got all this debt. And some people are gonna say, well, you just sell the property. Yeah, okay. In theory, if the market's doing well, some people can't just sell because they bought when prices are higher, and selling means they're gonna lose 100 grand. So it's not that easy either. So but you're 100% correct.
Great. Well, I hope that helped, Tom. And hold on to your thought, John, because the situation you just ended on is part of our next question.
Okay.
Hi, John. I was encouraged by a real estate broker to buy a property in Thorold, just outside of St. Catharines. He said it was a good deal and told me how freehold townhomes were in great demand. I purchased it for $790,000. Now the properties in the area are selling for about $635,000. That is, if you can even get somebody to buy it. Do you think I should hold on? The reason I ask is because I'm 65 years old, but I will not retire for the next 5 to 10 years. Do you think properties in that area will appreciate and I can just get someone to buy it? Then I don't want to be paying a mortgage since for the first 5 years, all the payment goes to the interest. So I will end up paying nearly double the amount for nothing. What are my choices? Thanks, Theodora.
Wow, what a question. Again, he- this is like this goes back to the last question. At the peak, everyone wanted to buy real estate as an investment. And everyone, most people saw people who wanted to cheerlead and explain to them. So, and I get why it's like, yeah, the realtors encourage you, but the reality is, and I hate to be mean, most people sought out that advice. Like I get people all the time calling about pre-construction condos for years. The second you give them the reasons why they shouldn't buy, they don't call you. They probably just call another person who's going to tell them why it's a great bet and sell them that pre-construction condo, even though there's a lot of risks to it. So people gravitate to people who tell them the story that they want to believe. Okay, is number one. Um, and I think we need to be mindful of that as individuals. Like it's easy to be sold a story about how you're going to make a lot of money and it's a great investment and so on and so forth. Most of the realtors, I mean, listen, this is the business they're in. I'm not going to say that they're not honest. They probably just believe that themselves. And if they could, many of them are loading up on real estate. Now, I guess the challenge with this question is if the viewer or reader doesn't want to pay mortgage, like what was the plan with this property? It would be my first question. Like when it was purchased 2 years ago, was the plan to just flip it? Which is the first red flag of dealing with a real estate agent. Like if your real estate agent just buy it and flip it, which is what like 90% of pre-construction condo realtors were saying, that is a massive red flag. Um, so if you don't want to pay a mortgage, why purchase it? Right? Why purchase it? Like if you're buying the home and they're 65 today, so what were they 63 to a couple of years ago? How does this fit into the broader retirement plan? Like, do you want to be a landlord, going forward? And so I don't have the answer to this. Again, it really just depends on the individual. Like if you bought it in cash, okay, they don't buy it in cash because they have a mortgage, right? But like for some people who bought it in cash, they just have that income stream, right? But if you have a mortgage, yeah, well, what are you going to do? Your options are, and I'm guessing they don't live in it. It was hard to, I don't know if they bought it to live in it. It doesn't sound like it. Maybe they bought it as an investment. So if it was just purely as an investment, you're either renting it for the next X years or you're selling it. And selling it at a loss obviously hurts. Like you're going to be down a couple $100,000 after the decline in value, plus the transaction costs when you buy and sell. So, again, this sentiment that we had in Canada that real estate always goes up, you should just buy anything. And that was the mood during the peak. I mean, that's not what I was advocating. I mean, for those who watch the show, I was a little bit uneasy about what was going on during the period in the run-up of prices. Um, so I guess I don't have any great answers for someone. And I've actually, for the record, had multiple people who called me in very similar situations who bought homes in 22. The realtor said it was a good advice. And of course, they wanted to buy in real estate because everyone's making money on real estate. It's the best way to make money and it's easy and you just buy property and it's passive income. And a lot of people are in very difficult situations because they're bleeding cash on the cash flow. And again, like this situation where the rent doesn't cover their carrying costs. And my instinct is if you bought a $800,000 townhome in where was it? Thorold, I think. Yeah, like outside of St. Catharines, with let's just say a 20% down payment, the probability that your rent covers your mortgage and your expenses is virtually zero, right? There's like almost no way because your mortgage payment on that is probably going to be like 3,500 bucks probably, if not more. plus your taxes, plus I don't think townhomes in Thorold are renting for over 4 grand a month. Um, so you're going to be short on your cash flow. So again, there's no perfect answer. And there's a lot of situations that I hear people are in. They have lots of investment properties are short $1,500 a month. It's obviously eating into their finances. So their question is, do I just keep paying $1,500 out of my pocket, which they can't afford? So maybe they're like borrowing it from somewhere else, or do they just bite the bullet and sell and they've lost 200 grand? And I don't know what the answer is. There's no brilliant solution. And this is why, like, again, like going back to our first question, it sounds old fashioned. It sounds very, cautious or risk. But at the end of the day, if you don't want to be in that situation, that is what you need to think about before you put pen to paper and buy a property. If you get caught in the exuberance and think you're going to be a real estate millionaire because some idiot real estate agent is pumping up the market and telling you you're going to be rich, listen, when someone's like, I'm always a skeptic. When someone kind of sells me that something's like a great deal, I'm always thinking about why it's not a good deal and why what I'm missing here, right? So again, the way to avoid being in this situation is thinking about these situations ahead of time. And again, you can't predict that prices are going to fall 20%. Don't get me wrong. Like this is not, but you have to be prepared for being in a situation where you cannot sell that property. Even prices are down 10%, it's still a difficult, you're down 100 grand, right? So yeah, I have no great answer. There's no perfect outcome here. You're kind of lose lose, and will price? I think one of the questions will prices go up there? I mean, possibly. I mean, I don't. We don't know. Like that's. I don't think we're going back to 10% year over year growth anytime soon, right? So yeah, we have a housing shortage. We have, our population, if our government scales it back and starts increasing at a more moderate rate, that's going to take pressure off of rent and house price appreciation. That's just natural. So will we go back to 3 or 4% growth? So yeah, maybe if you're holding it for 5 years, you may get back to what you paid for it, possibly. I mean, but again, you have to cover those costs for 5 years, and that's very hard, especially when you're at 65 and you're looking at retiring. You don't want it's like dragging a dead weight behind you, this stupid thing. If you're cutting checks for $1,500 a month just to carry the cost of it, it's not a great place to be at in your retirement, right? And that's, going back to your question about life changes. This is a good example of how a bad real estate decision can like significantly constrain and negatively impact your lifestyle because either this person has to somehow find whatever it is, a shortfall, let's just say $1,500 a month to float this thing, or their retirement savings, they've just lost 200 grand. Like either one is not a great outcome, right? And why anyone would suggest doing this in their retirement, I don't like it. It boggles my mind. Like, if you're doing a retirement investment, it needs to be something that is unbelievably secure and low risk and it drives your cash flow, your income, not sucks up your cash flow. So I don't even like, and again, this is an example. What the heck was this real estate agent thinking? Like I could never advise someone to do that. But you know what? I probably wouldn't have. And again, many of these buyers will be like, okay, well, thank you. If you don't think real estate's a good investment, I'll find someone who thinks it is. And again, I think a lot of people miss the point that, because they're not thinking about these things when they're making the decision, it's kind of hurting them after the fact. So there is no perfect answer, unfortunately. There's my long rant. I feel so bad for these people because I get so many calls and I don't have great answers. People are like, can you help me? And I'm like, there's no great outcome in these types of situations, unfortunately.
So yeah, sorry, Theodora, we're very sorry to hear about the situation you're in. I guess, John, by some of the wording there, I do wonder if this was bought as a new pre-construction townhouse, and maybe the thought was by the time you would have to take out a mortgage on it and it was
Yes,
completed,
you
it will
flip
have
it.
appreciated
Yeah,
and you could sell it for that profit. Now here's the opposite. Not only does this person not want to take the mortgage, they mentioned that it's underwater in this terms of price, but also did Theodore ever want to retire out to Thorold? Like maybe she never wanted to go there. This was a pure investment. So
Yeah.
you could even be in a position where maybe if you do own something somewhere else,
Yeah.
you may have to really shift your lifestyle in a profound way,
Yeah, and I
and
get the
even move
impression it's
there.
yeah, and I
Yeah.
agree with you. And it sounds like it's an investment. Again, it's for someone to say I don't want to pay a mortgage for 5 years. Well, then you probably didn't want to pay a mortgage when you bought it. So it's probably and maybe positioned as you just buy now, and then once it's done, you're going to make 100 grand, which obviously every realtor was or most realtors were saying in 2021 and 2022. But that obviously didn't materialize. And anyhow, yeah. And again, we're going to see that in the condo market. We're seeing in the low rise market. It's very difficult. And yeah, there's no yeah. I feel
There's no
sorry for
easy
the situation.
solution.
It's very difficult, especially someone who's about to retire to be in that position. And I think the only advice I have to people is you need to get more advice. Like honestly,
Yeah.
you
I
should
mean, a
not be
financial planner always tries to move
100%.
your investments from high risk when you have more working years
Hmm.
and to invest and recover from any issues. And then you start to transfer that, your financial investments into more and more secure investments.
Yeah,
This what you would consider very high risk. So
100%.
to be doing this as you're very close to retirement, like you said, absolutely doesn't make sense. Now, a real estate agent or broker might not tell you that, but if you
Yeah.
get a second opinion from a financial planner,
Yeah.
then maybe they could have pointed that out.
It's funny you say that. I actually said that to the person I was speaking with maybe a few weeks ago who follows our show and reached out about the same thing about like upsizing and keeping their home. I said, listen, this is my opinion. I go get a second opinion. Talk to a financial planner. Talk to someone else who will tell you a different perspective. And to be clear, when I give people advice, it's highly, especially when we have meetings, it's highly specific to their situation. Like I said, the risks when you have a townhome that you own in cash, no debt to upsize and keep it, are considerably lower than if you have a big mortgage on your investment. You know what I mean? So again, it's specific to each situations and their income and their expectations. Like that particular situation seems highly risky to me, which is why I said it seems like a relatively big risk you need to be prepared for, but get a second opinion. I think that's always the best advice to seek out a second opinion from someone.
And that's it. Every situation is so specific. That's why we named our segment "The Situation"
For
precisely for that
sure.
reason. Because we hear from people saying, "This is a situation I'm in,"
Yeah.
and the answer that you give, John, is not the same for
No.
any two people ever because their conditions, what they want to do, what their assets look like, where they are in their lives, so
Yeah.
completely different. And these are the moving parts that make it very hard for you to say yes, no.
Yeah,
So
exactly.
I hope that helps a little bit in a very, very difficult situation. Now, our last question for today, John, is a little forward thinking,
Hmm.
but potentially maybe more of the same, actually.
Okay.
Hi, John. I'm seeing a lot of construction starting on the new Ontario Transit line in the east end of Toronto, which obviously will take years to complete.
Hmm.
Would it be a good idea to invest in a home or condo near the line in an area that isn't very high priced right now, in the expectation that the transit line will eventually result in price appreciation? Thanks, Carly. And now, John, you and I are headquartered in Leslieville. We do see
Hmm.
quite a bit of construction starting around the Ontario line. It's an interesting.
Yeah. So for those who don't know, the Ontario line is a new subway line. Part of it is underground, part of it's above ground. That will be kind of cutting. It was starting effectively at the Ontario Science Center, or what was the Science Center after Doug Ford decided to kill it. So from that station, and then we'll be kind of cutting down south through Pape, through East York, through Leslieville, which is the neighborhood we're based in, and then go across sort of the downtown core towards the exhibition place. So yeah, great development, going to be
Ending up at
years.
the maybe the Doug Ford Spa,
Oh
right?
my
At
gosh, yeah,
Ontario
exactly. Oh
Place.
my gosh.
That's what gave it the name,
Exactly,
the
exactly.
Ontario line.
Um, so so going back to the original question, is it a good idea to sort of buy a home there in anticipation of higher appreciation? Again, like I don't want there's no like yes and no, all right? Like here's the thing. I think they overestimate the upside on appreciation from being next to transit, right? Because there are a lot of factors that impact it, obviously, like just geographic location plus your proximity to transit. So it's not like, house prices in Kennedy Station in Scarborough are remotely similar to a downtown station on the same subway line, completely different neighborhoods, right? But even if we're in the same neighborhood, proximity to transit. Like if you look at a better example is if you look at houses on sort of the Eglinton line, which is the LRT, which is closer to being completed if it ever is completed. It's not like home price. I mean, again, I haven't done the analysis, just this is my instinct. And maybe I'll look at it one day, but it's not like home prices closer to Eglinton have surged like to a degree that it is material and it is outpaced sort of all the other areas around it, right? It generally doesn't work like that. And even if you think about like even existing on the Bloor line, if you look at homes, I mean, if we look at the East End, for example, in East York, like our homes near the Danforth line, so much more expensive when you are further north and further south, right? Like not necessarily. Like there isn't a huge difference, right? Like, I mean, we're in Leslieville. Like it's not like the homes down here are 20% less than they are if you're on the Danforth. In fact, some of the pockets are actually more expensive. So it's not perfect, this idea that you're gonna get this huge increase in value. Like all other things equal, will it have a positive effect? 100% it will. Does it mean that that should be your primary consideration? No, definitely not. Number one, it's not gonna be done probably for 10 years. So I don't know if I'd be making decisions today and making huge sacrifices for something that is going to be done way down the road. I think just thinking about where you want to live over the next 10 years is more important than the potential difference in appreciation because I don't think that's going to be huge. Like, and what I mean is if you buy somewhere that is further off of the Ontario line and a home that you like more, should you buy that one rather than the one on the Ontario line? And my answer is yes. I'd rather buy the home that you like more, even if it's further from the Ontario line because I don't think there's going to be a big enough difference in their growth. And that's kind of what this question's about. Is it a good investment? Is it going to appreciate more? I don't, I, there's, it's not a, it's, I'm not convinced that the difference is going to be high enough to justify you going into a home that you don't like as much for the next 10 years while you wait for the Ontario line to be completed. So I would make that like a secondary consideration if it was me.
And I guess, John, the counter argument might be like something with Eglinton, like Eglinton, the LRT, the rapid transit is not open yet. Obviously, legendarily delayed, and in
Hmm.
fact, has become quite a nuisance to all the residents in that area for
Hmm.
many more years than they expected. However, if
Hmm.
you did get in earlier, once it's finished,
Hmm.
could you see a bump 10, 15 years from now? And there you're suggesting that the Danforth experience of that subway line suggests that it's not really that you're near the subway. There's a difference in where along that subway you are and which
Yeah.
pockets have appreciated faster than others, even along the subway line.
Yeah,
Is that fair to
100%.
say?
Yeah, and I guess that's one thing where you are along the subway line that matters. But even if you're around Greenwood Station, what I'm saying is I don't think there's like a massive difference if you are, 30 meters from the subway station versus 500 meters from the subway station. I don't think it, or whatever it is, or a kilometer, whatever it is. It's not a huge difference. Now, having said all that, okay. Having said the reasons why I might not, I'll give the counter sides to it that I think we need to be mindful of. Number one, the I think part of that has to do with the fact that many of those homes are semis. They're not going to get redeveloped anytime soon. The one scenario where there might be some lift, right? If you're thinking as an end user, is if you're buying a detached home very close to the transit, and if you're buying it in an area that might get redeveloped where a builder buys the property as part of a land assembly to sort of build, a condominium or something closer to the main transit line, right? So that might be one scenario where there might be more upside potentially. But even then, like when you look at what builders are paying for houses and land assemblies, it's not like everyone has this, idea. I mean, someone called me like 2 weeks ago. They're like, There's like the builder reached out to me about selling my home. They're trying to sell. He's like, and I would consider selling it to them for like three times more than what it's worth. And I'm like, I mean, it doesn't work like that. I think people have this notion that builders just pay any price. And usually, obviously it depends on the height, but in many of these areas, they're not going to be building 80-story towers, right? If they're building 20 stories, 25 or whatever it is, again, like even in those scenarios, I'm not convinced that even buying a detached home is going to be this massive lottery ticket. Like you might get a slight bump, but again, I think that's the one scenario maybe where you might get a little bit of lift, but again, I would not necessarily do it for that reason because it's again, you're making a kind of a speculative bet that maybe your property may be acquired in assembly and so on and so forth. I think you're just better off just buying a home you like and enjoying it for the next 10 years rather than trying to think about where prices may or may not be 10 years from now in one area versus another area.
My only final thought on this is Carly doesn't mention this, but what about if you're investing with a view to maybe making it a rental in the future? So, for example, you're trying to get on the property ladder, so you get a home that's, a real starter home.
Hmm.
I mean, maybe not in a really well-developed area. This Ontario line is going through a few neighborhoods on the East End that
Hmm.
may fall into that category,
Yeah.
right? Um, so you get into a starter home, it's not a great area, and for years and years, eventually the transit comes online. If you ever want to move out and then hold on to it as an investment, with all the
Hmm.
caveats we discussed
Yeah.
in the first question and the second, does it make it more advantageous to have that rental near that transit in that case?
Yeah, but I think that's a very good question, and I would agree with you. But if you're doing that, I think then you want to buy a home that you think will potentially be well suited to be a multiplex. Like just renting out a single family home, I mean, generally is not the best way to have a rental property. You want to be able to convert it, say, into a 3-unit rental property. So if that's the strategy, then yeah, and there are homes that are just more well suited to that type of conversion versus others. Like you don't want to have to spend a ton of money to do that. So if that's what someone wants to do, then yeah, I think that's a decent idea that you buy that for your starter home for 10 years. And if you can in the future, yeah, you convert it. You're creating housing, which is good. You know what I mean? Because that's a good way to be an investor. Like if you're taking a single family home, converting it into 3 homes, and fine, there's smaller rentals, but at the end of the day, it's more housing, then yeah, I think that's a good thing. So 100%.
But 10 years is probably optimistic if we're going to learn anything from Eglinton.
Yeah, for sure.
So, and as you said, I think the theme today was careful, careful, careful. All of these involve decisions in which you really are banking on that appreciation, right?
100%.
And that is not something you can just put in the bank, even though for
Yeah,
some years in the Toronto area, it seemed like that. We're in a very different reality right now.
we are definitely. Yep.
So thank you very much, John. As I mentioned, you can keep your questions coming. Ask John at Move Smartly. John's on Twitter at John Pasalis or X Twitter. We are there at Move Smartly. And if your situation was more personal and more detailed, you can reach out to John directly. His contact is in our show notes. So thanks again, John. Look forward to getting another round of questions asked and answered next month.
Sounds great. Yeah. Thanks for the questions, everybody. And yeah, looking forward to next month's show.